At night, Mike sleeps peacefully in his bed, unaware that in a few minutes his life will change forever. Outside, without a single sound, a tow truck pulls up. A man with a tablet silently hooks a chain to the family SUV. A minute later, the car is gone. Mike will wake up tomorrow to an empty driveway. This isn't the story of one unlucky guy. It's a symptom of a $1.69 trillion credit bubble. In January 2026, subprime auto loan delinquencies over 60 days broke through 6.9%. That's the worst figure in 32 years. Worse than even the peak of the Great Recession in 2008. How did buying an ordinary car turn into financial suicide for millions of Americans? Today we'll break it down through Mike, an ordinary guy who just needed a reliable car to get to work and take care of his family. This is Wick's Wealth, and this is a story about how the system is built for you to lose. But first, let's rewind a few weeks to that sunny day when it all began. Mike walks into a dealership with one simple thought. He needs a reliable car to get to work, and maybe drive the kids to school and take the family on trips too. He has no idea that in a few minutes he'll be trapped in a system he won't escape for years. A bright, sterile dealership showroom. A smiling salesman shakes Mike's hand like they're old friends. But here's the secret. Dealerships today don't sell cars. They sell a monthly payment. The average monthly payment for a new car in America has hit a staggering $748 to $772, and the car's price itself hovers around $50,000. For many families, that's an impossible number. So how does the salesman get Mike to say yes? Simple. He stretches out the loan term. Instead of the usual 5 years, the salesman offers an 84-month loan. A full 7 years of payments. The share of buyers taking 84-month loans has hit 22%, almost double what it was 6 years ago. And some credit unions are already offering 120-month loans, 10 years of payments for a single car. The psychology is simple. The longer the term, the smaller the monthly number, and the easier it is to say yes. Mike looks at the $650 a month figure and thinks, I can handle this. He signs the papers. But the salesman never mentioned one crucial detail. What happens to the car the moment you buy it? The second Mike's wheels touch the pavement, the new car has already lost part of its value. And a loan stretched over 7 years means Mike pays interest longer than the car will even last. This is called negative equity, and it means Mike owes the bank more money than his car is actually worth. And this isn't rare. Some lenders create this trap deliberately. Wells Fargo, for instance, tested issuing auto loans with a loan-to-value ratio above 140%. That means the bank knows from day one that you owe more than the collateral is worth. And companies like Carvana approve loans for people earning as little as $5,000 a year. Think about that, $5,000 a year, and the bank hands you a loan for a $50,000 car. This isn't customer care, it's math where the bank wins no matter what happens. If Mike pays, the bank collects years of interest. If he doesn't, the bank repossesses and resells the car. Mike drives away from the dealership, happy, keys in hand. He has no idea he's already trapped. For now, everything looks fine. The payment fits the budget. Life goes on as usual, but the system he just entered is waiting for one thing: the moment something goes wrong. And as we'll soon see, for millions of Americans in 2026, that moment comes far too quickly. A few months pass. We're in Mike's kitchen. The table is covered in unpaid bills. You might think Mike is just being irresponsible with money, but the reality is far more complicated. Welcome to the K-shaped economy of 2026, where some people get richer and others sink. Total U.S. household debt has hit a record $18.79 trillion. That's an all-time high, and credit card delinquencies have soared to a 16-year high, 13.1% of all balances. Mike's paycheck seems to be growing, but inflation eats that growth faster than he can notice it. This isn't a crisis of responsibility, it's a crisis of affordability, when everyday life costs more than a paycheck can cover. Every month, Mike has to choose: buy groceries, pay rent, or make the car payment. He can't choose all three. There simply isn't enough money for everything at once. And here's a key detail most people don't think about. In America, losing your car often means losing your job. There's no bus to the factory, no subway to the warehouse. A car isn't a luxury, it's a survival requirement. So Mike makes the one choice that seems reasonable in the moment. He pays for food. The car payment goes unpaid. A month passes, then another. Mike tells himself it's temporary. He'll catch up soon. That's what millions think right before everything collapses. But the bank doesn't wait for explanations. For the bank, a late payment is just a number that triggers repossession. And one morning, Mike walks outside, and the spot where his car stood is empty. This is the very scene we started this video with. Now you know what led to it. But Mike's story doesn't end here. It's only just really beginning. Financial experts love to talk about averages, but averages are a lie that hides the truth. The average American looks financially stable, but the median American, the one in the middle, is drowning in debt. Mike is the median. He's not rich, he's not bankrupt. He's exactly where the whole system breaks down. Compare two people, Rich Richard, who has a $20,000 safety cushion, and poor Peter, who doesn't have a cent beyond his paycheck. One missed payment is a catastrophe for him. Mike is Peter. Millions of Americans today don't even have $500 for an emergency. One doctor's visit, one broken fridge, and the entire month's budget falls apart. This is the hidden trap of the middle class. The appearance of stability with zero margin for error. And when the first blow hits, a hospital bill, a lost shift at work, a chain reaction begins. First the credit card payment slips, then the car payment. Then you borrow from one to pay another. This is called a debt spiral, and millions of American families are caught in exactly this right now. Mike isn't stupid or lazy, he's just a person caught in a system built against him. Without a car, Mike can't get to work. What does someone in this situation do? He looks for a replacement, fast and cheap. He finds a rundown lot with a flickering neon sign. Buy here, pay here. This is a separate, dark corner of the auto industry that most people have never heard of. Here, the dealer is the seller, the lender, and the debt collector all at once. And that changes every rule of the game. 78% of all loans in the BHPH sector go to subprime borrowers. People just like Mike. The salesman smiles at Mike just as warmly as the first dealer did. But behind that smile is different math. Before handing over the keys, the dealer installs a GPS tracker on the car. Officially, for safety. In reality, the device has one purpose: to know exactly where to grab the car the moment a payment is late. And here's the shocking number. The odds of repossession on a BHPH loan are 16.63 times higher than with regular lenders. About 5% of these dealers' loan balances are constantly in the repossession pipeline. This isn't a glitch. This is the business model. Repossess the car from Mike after his first missed payment and sell it to the next victim. The same car can go through this repossession conveyor belt dozens of times over its lifetime. Each time, the dealer collects a new down payment, new interest, and a new victim in the system. But the scale of the problem goes far beyond one used car lot. This toxic debt doesn't stay with the small dealer. It gets packaged into securities and sold on Wall Street. Sound familiar? It's the exact same playbook as the mortgage loans before the 2008 crash. When one of the largest BHPH operators, Tricolor Holdings, collapsed, the fallout wasn't limited to its customers. Two major banks each lost $200 million in that collapse. The scale was so alarming that it drew the attention of Senator Elizabeth Warren and triggered a major investigation. Think about that. A small used car lot on the edge of town and Wall Street, connected by a single thread. Mike just wanted to get to work. He had no idea he'd become part of a financial system that profits from his poverty. And Mike is far from alone. Across the country, millions of people go through this exact same BHPH funnel. Every late payment, every repossession, isn't an accident. It's a calculated part of the business plan. The system is built so that poverty breeds more poverty, and debt breeds more debt. While Mike tries to survive inside this funnel, something even more alarming is happening at the top. Millions of Americans, just like Mike, are now physically locked in, unable to leave the subprime loan market. And Mike isn't alone in this. Millions of people just like him are trapped in exactly the same situation right now. Mike and millions of others are locked into 7 and 8-year loans with negative equity on their cars. This means they're effectively locked out of the car market for almost an entire decade. They can't trade in for a new car. The debt is too large and there's simply no equity. A third of the market used to rely on leasing. People came back to the dealership every 3 years for a new car. Today, the leasing share has dropped to 17 to 18%. People are stuck with old cars and old debts. By basic economics, if demand falls because people can't afford new cars, prices should crash. But that's not happening. Automakers and Wall Street have found a way to delay the inevitable. It's called credit engineering, artificially stretching loan terms, just to make the payment number look bearable. Instead of lowering the price of the car, the industry just stretches the pain out over a few more years. This delays the collapse temporarily, but it doesn't cancel it. Sooner or later, the math catches up. And while the system holds together, people like Mike pay the price every single month of their lives. Mike's story isn't a rare exception. It's a mirror reflecting the entire American middle class. You may have recognized something familiar in this story. Your own payment, your own stress, your own kitchen table choice. So here's a simple truth. The math of debt is ruthless. It doesn't care whether you're a good person. Refusing to understand exactly what you're signing up for over the next 84 months is financial suicide. Before signing any loan, ask yourself one simple question. What will this car actually cost me in the end? Don't look only at the monthly payment number. Calculate the full total over the entire loan term. Ask yourself, what will the car be worth in 3 years compared to what you'll still owe? If the answer scares you, that's your signal to stop and reconsider, not to sign without looking. You still need a car, I get it. So here's exactly how to buy one without falling into Mike's trap. Rule 1. Get pre-approved for a loan at your own bank or credit union before you ever walk into a dealership. That way, the dealer competes for your business instead of controlling the terms of your loan. Rule 2. Never sign a loan longer than 60 months. If it doesn't fit in 5 years, the car is too expensive for you. Rule 3. Follow the 20/4/10 rule. Put down at least 20%, finance for no more than 4 years. And keep your total car costs, payment, insurance, gas, under 10% of your monthly income. Rule 4. Never judge a loan by the monthly payment alone. Multiply it by every month of the term. If that total number shocks you, it should. That's the real price you're agreeing to pay. Rule 5. Consider a reliable used car that's 2 to 4 years old instead of a brand new one. Someone else already paid for the steepest drop in value. You get almost the same car for far less money. Rule 6. If a dealer offers buy here, pay here, financing with no credit check, walk away immediately. That easy yes is exactly how the repossession trap we just described gets built around you. And Rule 7. Before you buy anything, save even $500 to $1,000 as a cushion for one bad month. That small cushion is often the only thing standing between a late payment and a repo truck in your driveway. None of these rules are complicated, but together, they're the difference between owning a car and being owned by one. Money isn't just numbers on a bank screen. Money is a tool for buying freedom and time. Every dollar that goes to interest on a bad loan is a dollar stolen from your future. Mike deserved to understand the system better. So do you. That's exactly why we make this channel. If this video opened your eyes, hit like. It helps the algorithm show this truth to more people. Tell us in the comments, have you or someone close to you faced a similar auto loan trap? And if you want to learn how to break free from a debt spiral step by step, subscribe to the channel. Wick's Wealth is your guide through a system that doesn't want you to understand the rules of the game. Until next time, take care of your money, ask questions, and never sign anything you don't understand.